Okay, and of course, I'm primarily known as an estate planning attorney, but I'm also a CPA, and although I haven't generally had a CPA practice because it's been focused on the estate planning, after the 2008 crash, I got licensed as a financial advisor, and so Right-Way Investments is our second business entity for doing financial planning for clients. Part of the reason I did that was because, as an estate planning attorney, I sort of have a ringside seat on how clients did, and I wasn't a financial advisor during the 2008 crash or during the tech crash in the early 2000s. And as a matter of fact, I worked with lots of financial advisors who sent me clients, but I got a real strong feeling about all the pain that families suffered during that 2008 crash and its aftermath, and the same back in 2002. So I've been a lifelong investor. I was in your shoes, right, trying to make my way through the Wall Street stuff and make money, and I was always real interested in it. But my first 20 years, I never made much progress. Then I came to kind of a different understanding about investments, and then after 2008, I thought, well, maybe I can help some of my clients with that. And so another feature of this is that going in the years to come, it would allow me to have a closer relationship with some of my clients if we were doing financial and tax planning. Because my experience has been, a lot of times we have a good relationship when we're doing our trust planning or our estate planning, but I don't see the clients for years and years. And then, lots of things happen during that time. So I'd kind of like to have a closer relationship with friends. So that's part of the reason for talking about taxes and investments. Let's see, what else can I tell you? I want to tell you about my grandchildren, but you probably don't want to hear about that. Let's see. Now, a few years ago, I joined the American Academy of Estate Planning Attorneys. Well, I'm board certified in estate planning. I've been in estate planning a long time. So why did I join this outfit, which is a national organization? What they do is they try to help law firms adopt best practices, and not just any law firms. They're exclusively focused on estate planning firms. And so they have about 150 law firms all over the United States. And they have nationally recognized experts on their staff, and they create the templates for the software that we use in our documents. And one of my concerns was that I wanted to make sure that we had the top of the line documents for our clients and that we kept them up to date. And so one of the aspects of being a member of the American Academy is that I feel like we have the best documents in the business for our clients. The other thing I wanted to do is, when you have a small business, it's easy for the small business to sort of be out on its own limb somewhere. And I want to make sure that we were maintaining best practices and we were staying up on all those things that might affect our clients. So that's the reason that I'm a member of the American Academy. So I really see our business as having three parts that can help clients. So obviously we have the estate planning part. Right now we do a few tax returns through the law firm every year. And these tax returns are done actually by my sweet wife. And you say, well, what does your sweet wife know about taxes? Well, my sweet wife is an enrolled agent with the IRS. And she ran our Jackson Hewitt Tax Service franchise in Katy for 15 years. And she has personally done thousands of tax returns and supervised thousands more being done. And so she's done tax returns all of every kind. At any rate, so she stays up on that. And so our clients that have the tax returns done through the law firm, it's my wife that does those. And the prices are typically reasonable. And what a lot of clients like about it is that most of the work is done through the mail or through email in getting the tax returns prepared. The other aspect of it is that if the tax return's done through here, then it's a chance for my clients to ask questions, tax questions or tax planning questions. Some of these are not huge, but sometimes you want the answer to a particular question, or you have some issue that's come up and you kind of like to look at it. So it gives a chance to touch bases on taxes. So if that suits you, that's something we do. And then I already mentioned that we have the financial services, and I'll talk more about that in a minute. So we want to be able to help you in these areas, and I like to have a closer relationship with a lot of my clients. Now the big deal is, of course, that they signed a new tax law, and that tax law changed the way that the setup for 2018 versus what it would have been. And you've heard all kinds of stuff about this. And of course, the administration says this was about tax simplification and was about lowering taxes. And the people who are critics of it said, oh no, it's not going to lower everybody's taxes, it's not going to have much effect, and so forth. So there's a lot of back and forth about the tax law. It looks like to me, and maybe I'm too optimistic, but it looks like to me for most of my clients and for myself, this should be, it should provide us with lower taxes. And that makes me smile, probably makes you smile too. So let's see how this works. Now one of the things they said at the first of the year, which is what they did is, for people who are working, there's a certain amount that's withheld out of your paycheck, right? The part of it's withheld is the Social Security tax. And another part that's withheld is withholding to pay your future income tax bill. And that withholding is based on the number of exemptions you claim, or whatever they call it. So it depends on that. Well, when the administration passed the tax law, they wanted to get money into the economy right now, right? They want to do something right now. So what they did is they changed the withholding tables that all the businesses in the world use, right? And so they lowered the amount that came out of people's checks. And this was supposed to be in line with what they were thinking would be lower taxes, so they would withhold less money. And that way people would get money in their pocket right away. Well, but one of the things they kept saying earlier in the year, and I don't know if you heard this, but I heard it several times through this spring and summer, you need to check your withholding, your allowances, to see whether you're going to be in trouble on your taxes next year, because they've withheld less than you expect. And I think for most people, that's not really a problem. And the people that it's a problem for are the ones that aren't going to benefit from this tax thing. And we'll talk more about that in a minute. But I think for most people, you'll be fine. Maybe you won't get quite as much money back if you had a lot withheld in the past, but I think overall you should be in better shape. Now, one of the big things, maybe one of the biggest things I think that changed for regular people is the standard deduction. And if there's, they kept talking about we're going to do tax simplification, and Trump was running around and said we're going to put this on one little card, right? Do you remember this? And then the critics all said, oh, and there's been a lot of jokes about whether this was tax simplification. But if there was simplification, it's probably right in here. So let me talk about this for a second. Here's the 2017 standard deduction. So in other words, when you fill out your tax return and you put all your income on there, you get to subtract your exemption, right? This standard, to deduct your standard deduction before you calculate your tax. So last year, if you were married filing jointly, it was $12,700, and if you were over 65, it was a bit more. Well, this year, it's $24,000. And if you're over 65, both the husband and wife are over 65, I believe it's 25.6. No, it's 26.6. 26.6. Okay. So in other words, it went from 12 something or other to, or 13, whatever it was for over 65s, to 26.6. It's doubled. Okay. In the 2 years. And you say, okay, well, how does that play in? I understand I'm going to get a bit bigger deduction, but if there's simplification, this is probably where it is. People who have a lot of deductions, like mortgage expense, property taxes, charitable deductions, medical expenses, that kind of stuff. Remember where that went? It went on Schedule A. And the name of the game was that if those deductions exceeded this amount, or if you were your head of household or single or whatever, if it exceeded the threshold, then you got an extra deduction for the amount greater than the threshold. In other words, you could take the amount on Schedule A, or you could take this exemption, right? So if you added up your property taxes and your mortgage and your charitable deductions, and they were over 12.7, well, then that's what you put on your tax return. You got a deduction. Okay? Now, my thinking, this isn't true for everybody, my thinking is that a humongous number of people in America, once this deduction jumps to double, once it doubles, a lot of people will not have enough mortgage interest, medical bills, charitable deductions to exceed this. Well, if you don't have enough to exceed it, you don't even need to keep track of it. You follow me, right? If you know that when you add up your mortgage and your property taxes and your charitable deductions, that's not going to get above this threshold, well, there's no use keeping track of it. So if there's any simplification, is that some people can just forget about messing with that and take the standard deduction. So that's a big change, and that's one of the reasons why the administration said, well, for most people, that's going to clearly make a difference in their taxes, but that's not the only thing. So they changed the tax brackets. They changed the percentage and where they went into effect. Okay? So this is the 2017, and it shows the 25% rate starting at 153. Okay? And this shows in 2018 the 24% bracket, pretty close, starting at 315. Okay, so 153, 315. Okay. Now, if you look at this thing, you'll see that they slightly changed the percentage in the bracket, and they changed the spread where the bracket was in effect. And so, again, for most people, that would mean you would pay less tax, right? Mm-hmm. You're going to be in a lower percentage tax bracket. It may not be a lot, but it's something there. So that was another reason why most people should pay less tax. Now, let me show you this. I went backwards a second. Now, another aspect, so this is ordinary income. Now, for people who are retired, you have, or a lot of people for that matter, but for people who have capital gains or qualified dividends, those are under a different table. And so, the rates, you can't see this clearly. This is zero rate, the zero bracket, the 15% bracket, and the 20% bracket. And so for married filing jointly, the zero bracket goes to $77,000. The 15% bracket goes all the way to $479,000, and above that's where the 20% bracket goes into effect. That is a lot of difference too. And also, there's another nasty little tax that goes with this. During the Obama period, they passed, I forget what they call it, I think some people call it the Obama tax, but anyways, if you hit this 20%, if you hit the 15%, you were in the 15% bracket, and then your income was over $250 if you were married, or $200 if you were single, $200,000 or $250,000, then you paid an extra 3.8, and it made this tax 18.8 or 23.8. So this is going to take most people out of, a lot of people are going to be out of that, and their capital gains are going to be, and qualified dividends are going to be taxed at lower rates. So again, it looks like that's positive for most people. Questions or thoughts? Oh, let me show you something here. I printed these out for you so you have something to carry away. And I actually seemed like me, I had a lot of trouble finding this, and I ended up taking the front page of my giant tax book over there and printing up. That shows the actual schedules if you want something to hang on to. I know it's hard to remember stuff like this when you see the slide. tax rates anyway. Okay, now here's where the critics of the administration said, hey, you've created a trap. And here's the trap. It says the new law limits write-offs for state and local taxes to $10,000 per tax return. And so Texas has, fairly high property taxes. People have, there's sales tax to consider. That's limited to $10,000. And it says if we file separately, could we get $20,000? No, you'd only get $5,000 each. So you have to get divorced to get two of those things. So it's probably not a good practical thought. But anyway, so that's limited. So who's going to be affected by that? Well, it's possible that somebody's going to be affected who has a really big mortgage and really big property taxes. I'm not sure how many people are going to be impacted by that. And again, it would have to push. They would have to have more than $24,000 if they're married for it to matter, right? Because they already got a double standard deduction. So it seems like that's fairly limited. But you could imagine somebody with a huge property taxes and being affected by this. The people that are adversely affected by this most likely are in the high tax states, in California and New York, where they have state income taxes and property taxes. So those are the people most likely to be affected. And of course, I don't know if you all read, did you all see in the paper, the governor of New York wanted to create a, quote, charity, make the state a charity, so that the New Yorkers who are going to be impacted by this would be able to get a deduction in a different way. so they were trying to finesse it, and so in California it's the same way. So the high tax, another way to look at this is the high tax states, they were using the federal tax code sort of to mute the effect of their high taxes. In other words, okay, you're going to pay high taxes in California, state and local taxes in California, right? But you get a deduction on your federal tax return, so it's okay. Well, when they did this, they messed up California and New York and these other high tax states. So I don't see how that's likely to affect many of us. I may be wrong, but I'm not sure that most people won't be affected. Okay, I'll be taking standard deduction. Should I pay down my mortgage since I won't be deducting interest? So what it's really saying is if I have this higher standard deduction, so now I'm not really, because I can't get this thing above 24 or above this standard deduction, and I total all this stuff up, then maybe the old advantage, they always said, well, you can get a tax deduction for your mortgage interest, right? That was that's why it's okay to have a mortgage, because you're going to get a tax deduction. So now that for many people, that advantage just won't be there. And also, they limited the interest you could write off going forward. So people that have home equity loans, if the money goes into their house, it's deductible. If they pay off credit cards with it or do something else with it, go on a trip, or buy a car with it or whatever, it's not deductible. Okay? So they kind of changed the landscape on mortgage interest. And of course, it says, should I pay it off? Well, that's, some people can pay off a mortgage and some people can't to start with. But I suppose the issue is what's the interest rate and what's the effect on your personal situation in deciding whether it's worthwhile to have the debt. I'm sort of a Dave Ramsey fan, so being out of debt seems very appealing to me. But I know some people see it, and many investment advisors talk about, well, if the interest rate's really low and you have other assets that you'd have to use to pay off that mortgage, and they're doing better where they're sitting, well, why would you pay off the mortgage with this asset that's doing better than your lower interest rate mortgage. So there's all kinds of issues there, but at least this may prompt people to ask themselves whether I still want to carry that debt or I want to go ahead and pay that thing off. Okay, now here is a really good one, and I'm real proud of this. I guess because, well, first I could have used this last year and I didn't pick up on it quick enough. So this year I'm going to use it, and I want to make sure you guys all know about it. So I've got a handout for you, but first let me just talk about it. So if you give money to charity, with this new standard deduction, unless you can get above $24,000 or whatever the standard deduction is, you don't get a deduction for your charities, right? You don't even keep a track of it because it's got to get above the standard deduction for it to be useful. So that's not too good. So you say, well, is there anything else I could do? And it turns out there is. Doesn't apply to everyone, but it applies to a lot of people, and it applies to a lot of my clients. So who are those people that it applies to? Here's what you do. If you're 70 and a half and you have an IRA 401k, so remember 70 and a half is the point where you have to take minimum required distributions. Okay? So if you're in the minimum required distributions mode with an IRA or 401k and you give money to charity, here's how to say to get this deduction, so to speak, and get the full value of the deduction in addition to the standard deduction. Okay? So here's what you do. You make your contributions to church or charity from your IRA straight to the charity. Okay, and the way that you do this is you inform the Fidelity or Vanguard or whoever it is that's the IRA custodian or 401k custodian that you want them to pay how many ever dollars to whatever charity. And what I think most of these financial institutions do or will do is send the check to you. So if you say I want to give $1,000 to my church here in Houston, you give them the name of that church, they'll make the check out to the church, send you the check, you give the check to the church. Now it is imperative that the charity the IRA custodian write the check to the charity. You cannot take the money out and then give it to charity and do what I'm talking about. Okay, it's got to go straight from the IRA custodian, 401k manager, plan manager, to the charity. The check has to be written directly to them. Now, the amount is not limited to your minimum required distributions. You can do up to $100,000 on this if you have the urge. Okay? So this is the way to make gifts to church or charity. And if you do that, you say, well, how does this work now? Well, what do I have to do on my tax return? You actually don't have to do anything on your tax return. Okay? What's going to happen is, eventually, you're going to get a 1099 from the financial institution that holds your IRA, showing the amount of distributions that you took. So if you're taking part, let's say part of it was a minimum required distribution that you're taking for yourself, and you told the institution to send another part of it to make the check out to your church. The part that went to the charity is going to be non-taxable to you on that 1099. And so it doesn't go on your tax return. It doesn't go into your adjusted gross income. So it's like it ain't there. Okay. Normally, if you take money out of an IRA, it is going into your AGI, and you're going to pay taxes. It's going to be part of the calculation. If you do it this way, it's not part of the calculation of AGI. And so it hadn't even entered the tax calculation system. It's just not there. Okay, that money is non-taxable. Okay, so this also has another good effect for some people. The Medicare premiums that you pay every month vary depending on how much income you have, right? So this could have the effect, depending on where you are on those Medicare thresholds, of lowering the amount of income that you're reporting, and it could lower your Medicare premiums. Okay, so it can have two good effects by doing that. Does that make any sense to you guys? Am I saying that clearly enough?
So you're going to wait for your questions afterwards?
Well, listen, no, we ought to ask you, no, go ahead and ask your questions here while we're thinking about it.
Okay, I want to make we're clear. So whatever your required distribution is, if you're pulling some of that out, going to your charity, church, what have you, okay, so they're reporting the balance as income only.
Right.
You're reporting, so your modified gross income is changed, is lowered, so you use.
Yeah, it's only going to show the part that was taxable.
Okay, does that also affect how you're taxed on your Social Security income?
It affects that Medicare premium.
That for sure, yeah. Okay.
Yeah, well, yeah, it could affect, it seems to me it could affect
'Cause I don't
the
know,
Social Security.
I don't know at what point the Social Security income is taxed.
Let's see, I don't know, I can't remember I don't know what it is this year. It used to be it was above, if your total of your, if you're married, the total of your Social Security and other income was more than 32,000. That may not be the right number anymore, but if it was more than 32,000, then the Social Security was potentially starting to be subject to tax. Yeah, so if you have, if you have Social Security and pension or minimum required distributions that put it in that territory, it's potentially going to create tax. So that might help lower the
I
tax.
just wanted to be clear that they're not just taking it from your IRA, they're taking it from your IRA distribution, so reducing the amount that you're actually getting reported as income. Okay.
Exactly, exactly. And so I presume the 1099 will show the total amount that came out, but it's going to show the part that's taxable and the part that's not taxable. That's what I was going to do. I haven't actually seen it. Now, that's a lot of information, and a lot of people can use it. I reprinted an article from the Wall Street Journal, and it goes into more detail about it, and I'll make it easier for you guys to remember this if you're interested. Also, if you have friends or family that make gifts for charity, seems like it's a mighty good thing to know. Assuming you got to be 70 and a half, okay? You got to have an IRA or 401k and be in the minimum distribution mode. It cannot go to I don't know if y'all are aware of this, but there are financial accounts called donor advised funds. And Vanguard, Fidelity, and all the big financial institutions have them. And what some people do is they give money to this donor advised fund, and when they give it to the fund, it's considered a charitable deduction. But what happens is it's just held in this fund until the donor decides what they want to do with it. The money has to go to a qualified charity, but it doesn't have to go right now. And so one of the big advantages for some people was that they could make a big year-end charitable deduction without having to think about who it was going to go to exactly, right? They could do tax planning by putting it into this donor advised fund. So there are a lot of uses for it. That will not work for this. You can't do that. Okay? What the rule is that the money, it can't go to one of these institutions that gathers money for charities, like the donor advised fund. It has to go directly to the 501c3 charity. Okay. I don't know how many people use donor advised funds, but they do have a lot of money in them, actually, as far as the great scheme of things. Okay, I think I already mentioned, you're not limited to, you could give more than your minimum required distribution up to $100,000 a year. Okay, another thing that, this is kind of a little wrinkle. It says, I'd like to take loyal clients to a dinner and a ball game. Can I still deduct the cost? For business owners, you have a 50% deduction for business meals. However, entertainment expenses are no longer deductible. For employees, neither meals or entertainment expenses are deductible. Also, for employees, unreimbursed mileage is not deductible. That used to be on Schedule A, and it was, you got above a certain threshold, that's just gone. Also, on Schedule A, you could potentially deduct investment advisory fees, IRA custodian fees, and all that stuff. It's gone. Okay. But course, for most people, jumping the standard deduction up so high makes it useless anyway. Most people couldn't get that high. There's a few employees that would be badly affected, might be badly affected.
Mm-hmm.
Can we still deduct medical expenses? Yes, the rule's the same. The medical expenses have to exceed 7.5% of adjusted gross income, and they go on Schedule A. So again, if for a married couple, you got to get above 24,000 or above 26.6 in order for this to work. Investment advisory fees on Schedule A, you can't get any money for that. Are families with children getting bigger tax breaks this year? Yep and no. Most families with children under age 17 are getting a major benefit, and that is that the child tax credit has gone up. I'll show that in just a second. However, it ends when the child turns 17, dropping to this $500. So in 2017, the credit for children was $1,000. Now it's $2,000. So that's another reason why the administration said we're giving a huge benefit to families with children by doubling that credit. But it drops to $500 once they're 17. It also phases out above certain amounts, but they increase the level where it phases out. So this thing phased out at 110 in 2017. It doesn't phase out until 400,000. So that should help a lot of families. And then, as you may remember, some credits are refundable. In other words, if you didn't make any money or you didn't have enough owe enough tax, you still got the credit. In other words, it was like you could get the credit even if you didn't owe any tax. Well, it's refundable up to $1,400 this year. So that was an increase there. So that's a help for children. Now, I don't know if anybody's affected by the alternative minimum tax. You hear stories about this, and they talk about what a mess it is. Well, but I have had very few clients that I have known that have actually been affected by this. Now, when your tax return is done, it has stuff on there about the AMT, and everybody goes, what is that? But then since it doesn't affect your taxes, you just need, right, it's just more gloop in your tax return. But at any rate, now they're saying that only 50,000 filers in the United States are going to be affected by it versus 4 million in 2017. So they've changed it dramatically, the number of people that are affected by it. So you say, well, what is it anyway? What's going on here? You have to, in my view, you have to have a kind of a weird setup to run into AMT. You say, what kind of a weird setup would you have? You'd have to be wealthy and have like a gigantic municipal bond portfolio, right? So you're wealthy, but all most of your income is tax exempt. Well, the government doesn't like that. So that would be an example. The other example would be someone who has considerable amount of income and huge deductions, where their income is almost zeroed out by the deductions. The government doesn't like that either. Okay, so that's why they have this thing. So, but it's only going to affect a few people. It's probably not going to get us. Correct me if I'm wrong. So you can see they created the huge difference. They widened the range and lessened the impact of the tax. Okay, now here's another one that got a lot of press, and that was that it's the 20% deduction for small businesses they talked about, or pass-through businesses that report profits on individual tax returns. Does my income from rental real estate qualify? Okay, so for people that have a sole proprietorship, or they have S corporation or a partnership and they have an interest in this, and they have some kind of ownership in those entities, they may get this 20%. Now, when I first heard about it, I thought it depended more on the business setup, but actually it depends more on the taxpayer's bracket is whether or not you're going to get it. So I don't know how many people are affected by this, but if you own rental real estate, you have a side business on that, or any kind of side business, and it's not a C Corp. In other words, this does not apply to some big corporation like Apple or Exxon. It's not for that. It's not C Corps. But other partnerships, SCorps, and sole proprietorships, that's who it applies to. And if, let me see if it talks about that. Basically, if your income, if a husband and wife's income is under about $300,000, you'll get it. If it's above about I think the number is 315. If it's above 315, it starts to phase out. Okay, so this again for small businesses, and it's going to be another tax break for a lot of people. 20%. And so what happens is the business figures out its net income, and it figures out its tax, and then let me say that. I'm not saying that right. Figures out its net income. Net income goes on the taxpayer's tax return, and if your income is less than that threshold, then you get to deduct 20% of the tax associated with it. Now, they talk about tax simplification. There's nothing simple about calculating this. So you might want to have a tax preparer on that, or software to deal with it. Okay, 529 accounts. You know what those are? That's where you can put aside money for grandkids or for kids, and the money grows tax deferred while it's growing. And then when you take it out, if you use it for qualified educational expenses like tuition and so forth, then there's no tax when it comes out. So it grows tax deferred, and then when it comes out, it's not taxed. So that's how 529 plans work. And so there's a lot of my clients have these. Well, one of the changes was that starting in 2018, money can be used for private school and tuition for kindergarten through 12th grade. So that's a big new deal, because so many people that I know of are trying to use private schools for little kids, not just college worries. They got worries with paying for tuition for private schools for younger kids. So this could be a big help. And so if you're a grandparent trying to help your grandkids or something, this might be an angle if using 529 plans.
Okay, is 10,000 the most you can pull out of the 529 per year?
No, it's just on this for private schools.
Just for private schools?
Yeah, it's talking about this. It's private schools where you're talking about kindergarten through 12th grade.
Okay.
College isn't limited.
Oh, okay.
Now, the ABLE accounts are for people who are disabled, and I'm not going to get into that. That's another type of gift account you can set up for disabled people. Estate and gift taxes, okay? Much to everyone's surprise, remember in 2017, the estate tax exemption was $5,400,000 per person, and they doubled it in 2018. So now the estate tax exemption is 11.2 million, and this year it's going to be in 2019 it'll be 11.4 million. So, but anyway, so a husband and wife can leave $22,400,000 to their kids with no estate tax. Okay, so it used to be, when I first started doing estate planning, one of the big deals was estate tax avoidance, because any couple that had more than $600,000 in the late 90s needed to do estate tax planning. Remember this, the husband and wife got 1.2 million. If they had more than 600,000, more than half of that they needed to have tax planning. Well, that's not even a worry for most people now, because the estate tax exemption is so high. Does that make sense? So they've shot it up. Now for people whose estate is between 11 million and 22 million, the concern is, or might be in the future, the concern is that when they wrote the law, it sunsets in 2025. And so in 2025, it goes back to what the old law would have said, adjusted for inflation, which is probably somewhere around 6 million. I may have a slide on here. Here's a slide. So it's showing that the estate tax exemption drops in 2026 to back to what it was in previous law. So that creates uncertainty for people that are in that middle range. But for most Americans, estate tax isn't a problem. Now, states in the upper Midwest, East Coast, West Coast, some of those states have their own state estate tax. So I still have clients that sometimes have a state, that they have to pay a state tax when a parent passes away because the parent owns property in Illinois or something. Texas has no death tax, okay? So for most Texans, estate tax is not the problem, okay? And this also means that for many of my clients who I've done estate planning for, they may want to, in some cases, they may want to simplify their estate planning by taking out the tax planning. Okay, so you can take that tax planning created things we had to do, special setup for the trust and so forth. Specifically, with tax planning, when the first spouse passes away, everything doesn't just belong to the surviving spouse. The deceased spouse's half goes in a trust. And you had to do this until 2013 if you were going to get both of their estate tax exemptions. So people that have done estate planning in the past have that trust in there to hold the deceased spouse's share. Well now, for most people, that's not necessary. There might be other reasons for having that trust, but estate tax isn't one of them. And so potentially they can simplify their planning by updating their estate plan and removing that tax trust so that the property just belongs to the surviving spouse. So that makes the settlement of the estate simpler. Okay? So that's a potential update note on trusts or wills that were done in the past years. Okay, so any questions on the things I've covered so far? Was that clear enough, or did I raise questions or something? Okay, next thing, Roth. Now I have I'm not quite this hot about this, but I have a financial advisor friend of mine, he's also a term CPA, and he makes a huge deal about Roths. He thinks that every client that can possibly do a Roth ought to do a Roth. Now it's not for everybody, we'll get into that in a minute, but they ought to do Roths or Roth conversions. And so the reason is that as the law stands, the earnings are tax-free on this Roth, right? And it's, you can create the things, there's no limit on age, and you don't have to take minimum required distributions out of the Roth, okay? On regular IRAs, when you're 70.5, you got to start taking that out, okay? Roth, you don't. So, it's in most states, I'm not sure in every state, but in Texas, all the IRAs and 401ks are creditor protected from lawsuit type creditors. Okay, that won't protect you if you run afoul of the FBI or if you run afoul of the IRS maybe, but from lawsuit type creditors, it's good protection. And you can always withdraw the contributions without penalty. And that's because they're after-tax assets. Okay, how do you create one of these things? Well, you open an account. Only one person could be the owner. Like your IRA, husband and wife aren't both the owners of the IRA. There's only one person that can own an IRA. And you can't change that. The person who created the IRA initially or created the 401k initially or the employer for whom the employee for whom it was created, that's the only person that can own an IRA as long as that person's alive. Now when they pass away, they can leave it to their spouse, and then the spouse can roll it over and it can become the spouse's. Okay? So, but anyway, that's what it's talking about, no joint owners. It's just like every other IRA. Whoever set it up, there's only one person that can own it. And then the beneficiaries, typically we want the spouse as the primary and the kids or the trust as the secondary beneficiary on IRAs, including Roths. Now there's two ways to do these Roths. One of them is to make a contribution, and the other is to do a conversion from your IRA, your taxable IRA. So, talking about Roth contributions, the limit that you can put in each year is $5,500 if you're under 50, I think it is, and it's $6,500 if you're over 50. You have to have earned income in order to do this. You can withdraw penalty free, and the problem with them is, for some people, that you can't do it if you're single and your income is over 120, or you're married and it's over 189. Okay? So for some people, that sort of stopped them in their tracks on creating the Roth. So another way to do this, in other words, that stopped them from creating Roths as they were going along because their income was too high. However, you can create a Roth by converting from your IRA. But the problem with that is you get to pay the taxes on that, right? Because anything that comes out of that, your regular IRA or 401k, is going to be subject to income tax. So you're going to take a tax hit if you convert it. No limit on the amount you can convert. Conversion is not for everyone because you've got to have the money to pay the tax and decide that was a good idea. And it doesn't really make sense to do that if you're going to be pulling out of this Roth over your retirement, and you'd be in a lower tax rate then than you are now. Why would you tax it now at a higher rate? It doesn't make sense. If your IRA is going to charity, there's no reason to convert it at all, because when an IRA goes to charity, they don't have to pay the taxes anyway, so it doesn't matter. So let me see if I can. So I have had clients do this, and at least in one case we did a humongous Roth conversion of the IRA. But several things to think about. Who would say this is a good idea? Because if you convert it, you got to pay the income tax now. Whatever you convert is going to end up on your tax return. It could drive you into a higher tax bracket than you are already. And if you just waited, let it grow tax deferred, and then you take out your minimum required distributions, you may be in a lower tax bracket. So how does this Roth make sense? Here's who it makes sense to. It makes sense to somebody who doesn't really need the IRA for minimum required distributions. In other words, they're not worried about or reliant, they don't feel like they need it or need all of it for retirement. And so if they had their druthers, they wouldn't take minimum required distribution, they just leave it there. And they kind of have the expectation, well, if I don't need it, and what I'd like to do, then it can go on to my kids. Right? So if that was the mindset, now the Roth starts to make sense, because now you can convert it on whatever schedule you thought made sense in terms of your own tax situation, and you don't have to take distributions out of it. And when it goes to your kids, you've created this vehicle that's it's going to grow tax-free, and it's going to be distributed tax-free. Now, when it goes to your kids, they have to take minimum required distributions, but that's probably their life expectancy is probably very long, and so the distribution amount they have to take each year is relatively small, and it's not taxable. And that Roth is growing tax deferred. So that's it. So it's somebody who doesn't feel like they're going to necessarily need all the money that's in the IRA, and if they don't have to use it, they'd like for it to grow and accumulate and maybe pass it on. That's the logic of Roths. Questions about that? Okay, so now let's talk about something else here. What do you do if, let's say you were above the threshold for creating a Roth because your income was too high to create a Roth straight away? How could you start doing this if you were in your working years? The way you do it is you make a non-deductible contribution to a regular IRA, and then you turn around and convert it to a Roth. Not a taxable event, because I mean you're using after-tax money so to speak, to create this regular traditional IRA, and then you're immediately converting it into a Roth. Now, so some people, you say, well, now that's a different deal, because one, I could do those on a smaller scale. If I was younger and I was working, well, that might make sense to have some assets that were in this Roth mode, where it can grow not only tax deferred, but there's never going to be any tax on it. So this might be a help to me somewhere along the line. So that's how you do what's called a backdoor Roth. You make a non-deductible contribution, and so for people that are limited in making a Roth directly, they're over the thresholds for doing that. This is how you do a backdoor Roth. Make non-deductible IRA contributions, you have to file this form, then you do a tax-free Roth conversion of the non-deductible IRA. And you can only put in, it's 55,000, $5,500 if you're less than 50, and it's 65 if you're over. So questions about that? So that's how you would do it if you wanted to do a little bit along, okay? If you wanted to do a big chunk, you can convert your IRA. But if you're doing big chunks, you need to sit down and figure out how to manage this and how to make it as efficient as possible and not trigger unnecessary income tax. And also think long term, what are my goals with respect to this Roth IRA asset? Does that make sense? Okay, another thing that's on people's mind is the market, right? So remember, we've had a number of years where the stock market has gone generally up. Now, I don't know about you, but I think for most people, we feel so smart when the market is going up. If we're invested in the market, we just feel so smart. We're so smart that we don't really need help from quote, experts or financial advisors, because we're so good at it. A lot of times we beat them anyway when the market's going up. So that's a real happy deal. When the market starts to get really choppy, like it's been this fall, it's like it happens to everybody. It happens to me too. I've been playing this game an awful long time. When the market starts to go down, notice what happens on Wall Street. When the market is going down, all the people who think that the world is going to come to an end immediately get on, Fox Business News or the Wall Street Journal or whatever you're reading or looking at, and they're telling you about, I'm not sure we're going to be able to come out of this, things aren't looking good. And so it's like a multiplier of gloom. And they have the other thing when the market's going up. When the market's going up, then all the rosy predictions make you feel like, man, I better get in on this before the party's over. When it's going down, it's like, oh my goodness, I'm not sure what to do. And then the problem that we have, well, a couple of problems. One problem is that for a lot of people, the joy of markets rising is less than the pain when markets decline. It's like, in life, we don't have as much fun when it's going up as we have pain when it goes down. It's like it's asymmetrical. So that's another problem. Now, another problem with this is that when the market starts to go down, we question what we've done, even though we were real happy with it until last summer, let's say. So just for example, not to pick on anybody or anything in particular, Apple stock has been a long time winner in the market, right? And I think it was last summer, there were all these headlines saying Apple was the largest company in the world by market capitalization. Market capitalization means if you take all the stock out and multiply it by its value, and it was $1 trillion company, which is kind of remarkable if you think about Exxon owns so much stuff everywhere, right? And it really is a big company. And Apple, which in terms of number of people working there and all those kinds of metrics, stuff they actually own, their stock was more than Exxon stock at that point, just for example. Anyway, so a lot of people felt mighty good about that. But if I'm not mistaken, Apple has gone down like 30% since last summer. It's no longer the $1 trillion company. And so then, let's say, I know one of my clients had a big stake in Apple, and he's been proud of that thing for years, and he would always tell me about it and how good it was, and how fast it was rising, and how much money he made. And I haven't talked to him about that in the last little bit, but I imagine that after going down 30%, it raises a lot of questions. And the questions go like this: should I have sold already? Right? Should I have sold? Did I miss the point where I should have gotten out, or I should have lightened up on the Apple stock? So that's the kind of question we ask ourselves. We ask ourselves, well, I wonder if the whole landscape has changed with Apple. They rode the iPhone so far. Are they now going to be eclipsed because something else is going to be the big new thing, and Apple hasn't come out with the new product lately? And so it raises all those kinds of questions about our portfolio. So this time when it's choppy is a good time to take a look at our own situation and decide whether we have confidence in what we're doing and whether there's a need to make adjustments. Now, the market has generally been up since the Trump election, but it's been taking quite a slide here lately. This is from last spring, and just because this chart was kind of dramatic. This kind of stuff makes people anxious when the trend seems to be down, to put it mildly. Now, stock market corrections are going to happen as retirees or as investors. What we want to have is a certain amount of peace of mind about what we're doing with our investments. So a lot of times, these times when the markets are choppy is a good time to assess where we are, where we're going, and what we're comfortable with. The other aspect of this is that for husband and wife, a lot of times the husband and wife are not really on the same sheet of music with their investments. In other words, maybe one of them isn't very much involved to start with and might be pretty conservative about things, and the other one's involved and not so conservative. If something happens to the one that's managing it, it creates all kinds of anxiety for the surviving spouse in that situation. So if the family is going to avoid taking a big hit when one spouse passes away or the market crashes, it's a time to make sure everybody's on the same sheet of music. So it may be a good time to analyze what you're doing, where you're going, how it's all been. Now, as you probably know, or maybe not, risk and return depend on what you own. So let's say that's too obvious, but a lot of people, a lot of advertisements and a lot of financial talk seems to not believe that. So I hear ads and I read material from other investment advisors where they talk like that they're going to give you the winners but keep you from losing. Okay, in other words, they're going to manage things so that you're in the winners but you don't take the losses. Another way that this gets expressed is people will say that if you're a really smart investor, you don't want to have the down risk. You just want to have the growth, the upside. This is virtual. A person that accomplishes this was lucky. Okay? The simple fact is that the research, I'm talking about Nobel Prize winning research, I'm talking about the research and studies that have been done, they all say that this is not really feasible. It doesn't work. If somebody pulls it off, they were lucky. So really the nature of the game, an asset that is safe will have a lower return. An asset that is volatile will have a higher return. Okay? And so in a way this makes sense. If you're investing in CDs, well, you're not taking much risk and the bank can't take much risk, and so the returns are lower. If you're invested in stocks, the returns are higher because the risk is higher. So these things are related, and they can't really be uncoupled. You have to, if you say, I want safe stuff, you're not going to get the same return that you would get with a portfolio that's more growth oriented, for example, just that simple. There is no free lunch here. So kind of understanding that. The other thing that you want to understand as an investor is how much punishment can I take before I decide I have to sell out? Because a lot of times the damage that was done in 2008 and the damage that was done in 2002 that I saw was because people had portfolios and they held on until all the news was bad, and then they gave up and sold out. And in some cases, they just went straight to CDs, or they bought annuities, or they sat out. And in that case, they took the loss. And a lot of those people in 2008 never recovered from it, never got back into the market. So they took a permanent loss at that point. Now, this is just human nature to do that. So how do you beat it? You gotta know, or believe, that the stuff you hold, if it goes down, will go back up. And you also have got to, come to grips in your own mind with how much decline in value can I stand before I'm going to bail. We don't want to be there, okay? Because the game is to hold the stuff, the good stuff, and that's how you win long-term as an investor. But these choppy markets make us crazy, and down markets make us do dumb things. And where the family isn't on the common sheet of music and one spouse dies, that's another big chance to take a huge loss. So when things are going along, it's fairly flat and up, everybody's happy, it's easy to manage. The problem comes when one spouse passes away and there's not a clear plan, or when the markets are chopping it down. That's when there's a tendency to make a lot of mistakes. Well, you make a mistake when the markets are all high too, like the tech bubble. But there's a lot of places to make a mistake. But it's typically not when the market is up for a long period of time. So the point is that there's a lot of people that are sort of complacent about where we've been. So it may be a good time to take another look. So how can we help you? Well, obviously, if you need to update your estate planning, I'll be delighted to do that. We do that, and we're proud of what we do. Also, as you may or may not know, depending on how much you've seen of our stuff, we do a lot of assisting families with Medicaid planning for nursing home care. So if you have an elderly, brother, mother, father that is on the verge of needing nursing home care, and there's not enough money to pay for that, as you all know, it typically costs $5,000 to $7,000 a month for someone to stay in a nursing home if they need that kind of care. So it's very expensive. Then we help a lot of families with qualify for Medicaid benefits. And this is one of those things. Don't wait till you've used up all the money. Come see us early in that process. So if a mom or dad or a brother or sister looks like they're going to need nursing home care, come see us sooner rather than later, because it's likely we can save the family a ton of money and qualify for Medicaid sooner. Also, the law firm, the Bond Law Firm, is one of a handful of law firms here in the Houston area that do a lot of returns. So there are lots of law firms say they do elder law planning and Medicaid, but our law firm really does a lot of applications, so we have a lot of experience in this. Okay, the other thing we can help with if you'd like us to handle your tax return, you have tax questions, you'd like to be able to check in on that yearly, well, that's an option with us. And if you want to do that, the way we would start the process is you'd say, well, I'm interested in that. And then my sweet wife, Jeannie, will give you a call and talk a little bit about your current situation and get prior year tax return or two so she can see what the situation is. And then she can give you some idea of what the cost of the tax return would be. And then you would send in your 1099s and other tax information. That could be done by the internet, it could be done by mail, it could be dropped off at the office. And then Jeannie will talk to you about the tax preparation, get your tax return to you, and so forth. So that's kind of the process, usually pretty painless for our clients. And if we can help you with your own financial planning, what we offer is a financial investment analysis geared to your personal situation and your current investments. So what we try to do with this, with the financial plan is to assess your current situation, look at things like, okay, if you're planning for retirement, have you got enough? If you're in retirement, how is that proceeding? Have you got enough resources, the resources that you need? So we've tried to provide analysis that are useful for your particular financial situation. We'll also look at the way you're currently invested, and we'll do an analysis that will give us an idea about, historically speaking at least, how that kind of investment would do over the long term. And so this gives us another way of picturing, okay, are we in pretty good shape? Do we need to budget more? Are we fine? So it can be both reassuring, or it can be a call to action in some cases. But the point is, a lot of people, a lot of us, it's easy just to drift through, right, and kind of hope for the best. But it would be, for many clients, it would be helpful to let us do the analysis, and you'll have a chance to talk with me, and maybe that is a way of creating a plan that gives you an idea of where you are and where you want to go. Okay, so we do that plan, and then if we can help you with your actual investments, we can also do that. But kind of it starts with trying to work, what are your goals and where are we and what might be the problem. That's what we're looking for. So if you'd like to do that, the way we would start that is we would have an initial consultation. We'll gather some information at that initial consultation, and I'll prepare this financial plan. I'll run at least part of it by you over the phone or through email and so forth, and then we'll have another meeting and go over and make sure we've got a meeting of minds about it. So that's kind of how it works. And the cost on that, right now what we're charging is $1,500 for that, so I think it's a good value. Questions? How am I doing on time? Did I run way over? No, too bad. Questions, thoughts? You guys are kind of quiet.